All right, so you're looking into high-yield dividend stocks.
Specifically, MFA Financial and Analysts Capital Management.
Those are some big names in the space.
Yeah, they are.
But
Yep.
before anyone just chases those big percentages,
Right, gotta look under the hood.
we need to unpack what's really going on.
What's the story behind the numbers?
Exactly.
Love it.
So let's break it down.
All right, let's do it.
Think of a dividend yield like this.
Okay.
You buy a share of a company.
Yeah.
They pay you a little rent just for owning it.
Okay. I like that analogy.
Easy to understand.
Yeah.
And it's calculated pretty simply.
How so?
Annual dividend income
Okay.
divided by the stock price.
Straightforward math.
Yeah. So, for example,
Yeah.
a $10 stock paying $1.30 in dividends per year.
Okay.
That equals a 13% yield.
Which sounds pretty darn good.
Right.
Yeah. Who wouldn't want that?
Exactly. But
Here's the thing.
there's always a but, right?
Always a but.
Mm.
High yield can be tempting.
Oh, yeah, for sure.
It can also be a warning sign.
Is it a bargain?
Or is there something else going on?
Exactly.
We need to figure that out.
That's where our deep dive comes in.
Let's dive in.
We're going to look at what these companies actually do,
Okay.
analyze their financials.
And see what the experts are predicting.
by the end,
You'll have the insights you need.
to make informed decisions.
Love that.
Yeah.
So
Key point here.
what's crucial to understand is,
A high yield often shows up when a stock price falls.
okay, so that falling price,
It could be a buying opportunity.
it could also signal underlying issues?
We got to figure out which one it is.
Right. So how do we tell the difference?
Between a sustainable yield.
And one that could just disappear.
Yeah, good question.
So how do we tell?
It's all about digging a little deeper.
Deeper.
Yeah, if a company's paying out huge dividends
Mm-hmm.
while their earnings are declining,
Okay.
that's a major warning sign.
Red flag.
Big red flag.
Got it.
It could mean their payout ratio.
Payout ratio, the percentage of earnings they're paying out as dividends.
Okay.
It's too high.
Okay.
And eventually,
They might have to cut the dividend.
and that would hurt your investment.
For sure.
So that's something to really watch out for.
Absolutely.
Yeah.
So before we even look at these specific companies,
Okay.
MFA or Analysts,
Yeah.
what are some general things to think about when it comes to high-yield stocks?
High yield in general.
Yeah,
Like some of the things to
what
consider.
are the benefits?
Well-
What are the risks?
Yeah. Good question.
Lay it on me.
Okay. So on the plus side,
Okay.
high yield stocks can provide a consistent stream of income.
Okay, consistent cash flow.
Yeah. Which
Right.
can be really appealing
Yeah.
for certain investors.
Who might that be?
Well, think about folks who need that regular cash flow,
Makes sense.
like retirees, for instance,
Right.
or people relying on their investments for income.
Steady income.
Exactly.
I'm right.
Another benefit, high yield stocks can sometimes act as a hedge against inflation.
Okay, how so?
If the dividend grows faster than prices in general,
Oh, interesting.
your purchasing power can stay ahead of the curve.
Okay.
And let's not forget
Yeah.
the power of compounding.
Reinvesting those dividends
Yeah, over the long term.
can really boost your returns.
It's like a snowball effect.
So there's a lot of potential upside.
There is
But I know there are two sides to every coin.
always
What about the downsides?
what could go wrong.
Yeah, what are the risks?
Yeah, so the biggest one,
Okay.
as we mentioned,
Those dividend cuts.
ouch. Yeah, those can hurt.
Companies hit rough patches.
It happens.
They're
The
different.
dividend is the first thing to go.
Okay.
Another thing to consider is sector concentration.
What do you mean?
High yield stocks tend to cluster in certain sectors,
Like
real estate,
Okay,
energy.
got it.
So if that sector takes a hit,
The whole portfolio could feel it.
exactly, diversification is key.
Right, spread the risk.
And one more thing,
Okay.
remember that interest rates can impact high yield stocks.
How so?
When rates rise,
Okay.
fixed income investments become more attractive.
Right, because they offer a guaranteed return.
Exactly, and that can make high yield stocks less appealing in comparison.
Okay, so interest rate risk is definitely something to watch.
Definitely a factor to consider.
All right, so we've got a good foundation now.
Yeah, we've covered the basics,
The basics of dividend yields,
the potential benefits,
the risks.
all the good stuff.
Now let's dive into the specifics.
Starting with MFA Financial.
What's their story?
Well, MFA Financial,
Uh-huh.
they're a real estate investment trust.
REITs.
Exactly.
And for anyone who needs a refresher,
Sure.
REITs are companies
That own
and often operate
income-producing real estate,
shopping malls,
apartment buildings,
office spaces.
you name it.
They generate income from that real estate
And then they distribute that income to shareholders.
in the form of dividends.
Exactly.
So MFA
They specialize in residential mortgage assets,
mortgages.
but their niche
Okay.
is non-agency MBS
Non-agency MBS.
and whole loans.
Okay, so break that down for me.
What does that actually mean?
Yeah, what's the difference?
Agency and non-agency MBS.
And why does it matter?
Great question.
So
Think of it this way.
Okay.
Agency MBS,
Uh-huh.
they're backed by government agencies
Okay.
like Fannie Mae and Freddie Mac.
So there's less risk.
Right, because the government's essentially guaranteeing those loans.
Oh,
Non-agency MBS,
yeah.
they're not backed by the government,
So more risk.
but potentially higher returns.
Makes sense.
Higher risk.
Higher reward.
That's the trade-off.
Got it. So MSJ.
By focusing on this niche, they're tapping into a different...
potentially more lucrative segment of the market.
Interesting.
They're taking on more risk
Yeah.
for the chance of higher rewards.
High risk, high reward.
Exactly.
Okay, so let's get down to the numbers.
Right.
What's their current dividend yield? And their payout ratio.
Nitty gritty.
Okay, so MFA,
Yeah.
currently offering a dividend yield of around 13.3%.
Wow, that's eye-catching.
It is.
And their payout ratio.
Sits around 75%.
Meaning,
They distribute 75% of their earnings as dividends.
and reinvest the remaining 25%.
Exactly.
Okay, so they're not just throwing all their cash at dividends. They're
Right.
being strategic.
It indicates a balanced approach
Rewarding investors.
while still aiming for future growth.
Makes sense.
Yeah.
But how does MFA actually generate that income?
How do they make money?
What's their business model?
It's actually pretty straightforward.
Okay, lay it on me.
MFA makes money the way most lenders do,
Okay.
by charging interest.
On their mortgage assets.
Exactly, those whole loans.
Uh-huh.
And non-agency MBS we talked about.
Okay.
And importantly,
Yeah.
their portfolio is diversified.
Diversification.
Always a good thing.
Spreads the risk.
Exactly. They're not putting all their eggs in one basket.
Right, which is smart.
Very smart. We've talked about their niche,
Yeah.
their dividend.
Business model.
Now, what about their overall financial health?
Like, how are they actually performing?
In terms of revenue growth,
Profit margins.
cash flow,
Can they keep paying those dividends?
that's the million-dollar question.
So spill the tea.
Okay. Well,
Mm-hmm.
looking at their financials,
Yeah.
MFA has shown strong performance
Good.
with steady revenue growth.
Mostly from interest income.
Exactly.
And their profit margins
Healthy.
suggest efficient cost management.
Absolutely. They're running a tight ship.
Good to hear.
Yeah. And most importantly,
Yeah.
their cash flow is robust.
Robust. They should have no trouble maintaining those dividend payments.
Knock on wood.
Fingers crossed.
Exactly.
So that's a good sign
Yeah.
for investors seeking that consistent income.
Definitely a plus.
What's the expert view on MFA?
What are the analysts saying?
Are they optimistic?
The consensus is a buy rating.
Okay, so they're bullish.
They are.
And what are they basing that on?
Current valuation,
Okay.
asset performance.
Okay, so they see potential for further stock price appreciation.
Combined with that attractive dividend yield.
MFA is looking like a pretty compelling investment.
Potentially.
So they've got solid financials,
A high dividend yield.
positive analyst sentiment.
So far, so good.
But what's driving this potential growth?
What are their key strategies for the future?
What are they doing to stay ahead of the curve?
Well, for one,
Yeah.
they're strategically expanding their holdings.
Of what?
Residential whole loans.
And why is that significant?
It aligns with current real estate market trends.
Interesting.
They're also continuing to diversify their portfolio.
Diversification again.
Can't emphasize that enough.
Manage risk.
And generate income from various sources.
Smart moves.
Always good to have a plan B
And a plan C,
and maybe even a plan D.
just in case.
Exactly.
All right, so MFA is looking pretty good.
On paper, at least.
But no investment is without risk. What are some potential challenges
Or pitfalls.
investors should be aware of?
Yeah. It's important to be realistic.
Always.
So for MFA,
Yeah.
one of the biggest concerns is interest rate volatility.
Interest rates going up
Or down.
could negatively impact the value of their mortgage assets.
Yeah, if rates spike suddenly.
It could really hurt their bottom line.
Exactly. So that's something to keep a close eye on.
Okay.
And then there's the inherent volatility,
Who?
the real estate market.
Yeah, you never know what's going to happen with housing prices.
Exactly. If they take a downturn,
It could hurt MFA's returns.
for sure.
And finally,
Don't forget about those non-agency MBS.
right,
They carry more credit risk.
meaning
If borrowers start defaulting on their loans,
could take a hit.
it could impact their profitability.
Okay, so we've got a pretty good picture of MFA Financial now,
Yeah, solid financials,
attempting dividend yield.
but with some potential risks to keep in mind.
All right, now let's turn our attention to Analysts Capital Management.
the other big player in the space.
How do they compare?
Well, Annaly,
Yeah.
they're a giant in the world of mortgage REITs.
Giant.
One of the biggest players out there.
And their focus.
Primarily on agency MBS.
Remember,
Those are generally considered less risky.
than the non-agency MBS that MFA specializes in.
Exactly.
So they're playing a slightly safer game.
In a sense,
Tell me about their business model.
how they generate those profits.
How do they make their money?
It's a bit more complex,
Oh, boy.
but I'll break it down for you.
Please do. So Annaly is sticking with the government-backed securities.
Yeah, they're playing it a bit safer in that regard.
Interesting strategy.
It has its pros and cons.
So how does that impact their business model?
Well, their approach involves something called leveraging.
Leveraging.
Yeah, it basically means
Okay.
they use low-cost debt.
Borrowing money.
Exactly.
Right. At low interest rates.
To buy higher-yielding agency MBS.
Okay, so they're using borrowed money.
To invest in assets that pay a higher rate.
And the difference between those two rates?
That's their profit.
called the spread.
Exactly.
Ah, so it's a bit of a balancing act.
It is.
But that leverage also means they're more sensitive to interest rate changes, right?
That's a key point.
If those borrowing costs go up,
Faster than the yields on their MBS,
their profits could shrink.
and that could put pressure on those dividends.
Makes sense.
Yeah, it's a trade-off.
Risk noted.
Got it.
Let's talk numbers.
Okay.
What kind of dividend yield are we looking at with Annaly?
And how does their payout ratio stack up against MFAs?
Give me the rundown.
Okay, so Annaly's current yield,
Yeah.
about 12%.
Not quite as high as MFA's 13.3%,
Right, but still very attractive.
for sure.
However,
There's that, but again,
there always is.
what's the catch?
Their payout ratio is a bit higher.
Than MFA's.
Yeah, it's around 85%.
Meaning?
They're distributing a larger chunk of their earnings to shareholders,
Okay.
leaving less room for reinvestment.
And potentially making the dividend.
More vulnerable to changes in their profitability.
So a bit more aggressive with their dividend payouts?
Can you see that?
How do their revenue streams differ from MFA's?
Good question.
They both deal with mortgages.
But their approaches are quite different.
Break it down for me.
Remember, MFA's income
Yeah,
mainly comes from interest on their mortgage assets.
right. Those whole loans and non-agency MBS.
Exactly. And
And
via
the-
revenue,
Huh?
it's all about that spread
Between interest income on their MBS portfolio?
and the cost of the debt they use to finance those purchases.
So it's a more intricate model,
It can be,
but potentially more profitable.
but they manage those borrowing costs effectively,
So Annaly's walking a tightrope,
in a sense,
trying to maximize that spread.
while keeping their borrowing costs in check.
Do they rely solely on agency MBS?
Or have they diversified at all?
Good question.
So the bulk of their portfolio
Uh-huh.
is in agency MBS.
Oh, okay. But there's that, but again,
Haha, you know it.
tell me.
They also invest in commercial MBS.
Okay, backed by commercial properties.
Exactly.
So that's a little bit of diversification.
It is.
And they also hold,
Mortgage servicing rights.
which generate income.
From managing those mortgages.
Okay, so they've got a few different irons in the fire.
A bit more diversified than it might seem at first glance.
So how's their overall financial performance?
Are they healthy?
Stable earnings?
Manageable debt.
And most importantly for our listeners,
Those dividends.
have they been reliable in the past?
Let's take a look.
All right.
So Annaly's track record is pretty solid.
Okay.
Consistent earnings.
Which is a good sign.
Yeah, it suggests stability.
And their debt levels.
Significant due to that leveraging strategy.
Right.
But manageable.
With strong interest coverage ratios.
Meaning
They can handle their debt obligations.
they can pay their bills.
Music to an investor's ears.
Exactly.
And looking back at their history,
Yeah.
consistent with maintaining,
Or even increasing those dividends.
showing commitment to shareholder value.
They want to keep those investors happy.
Absolutely.
So overall,
Yeah.
they're financially sound.
But what's the word on the street?
What are analysts predicting?
Are they bullish on Annaly?
Yeah, the analyst community is pretty optimistic.
Strong buy rating.
Exactly.
What's driving that?
Well, they see potential for both capital appreciation.
Meaning the stock price could rise?
Exactly.
Okay.
Continued strong dividend yields.
Okay, so a potential win-win for investors.
Potentially.
But the market is always changing.
Never a dull moment.
What are they doing to stay ahead of the curve?
To navigate those potential risks.
Are they proactive?
Very much so.
How so?
Well, Annaly's very active in portfolio optimization.
Okay.
And risk management.
They're not just sitting back and hoping for the best.
Definitely not.
So they're constantly analyzing market trends.
And adjusting their holdings accordingly.
And they're laser focused on managing that interest rate risk.
Which, as we discussed,
crucial for their profitability.
Absolutely.
So they're not resting on their laurels.
Always looking for ways to improve.
That proactive approach is encouraging.
Yeah, it shows they're taking risk management seriously.
But even with those efforts,
There are always potential challenges.
what could impact their performance down the line?
Well, interest rate sensitivity is a major factor.
We've talked about that.
Yeah, if rates rise rapidly
That could really hurt their profit margin.
and potentially impact those dividends.
And what about prepayment risk?
Another important consideration,
And explain that one.
if borrowers refinance their mortgages,
Okay.
leading to earlier than expected repayments on Analysts MBS holdings.
Their yield could go down.
Exactly.
Okay, so prepayment risk is something to watch.
Definitely.
And finally,
We can't forget about regulatory changes.
the government could always throw a curveball.
They could,
And that could impact the entire REIT industry.
creating unforeseen challenges.
So lots of potential risks to keep in mind,
Always,
but also potential rewards.
if things go well.
All right, so we've got a clear picture of Annaly now.
A mortgage REIT giant.
Solid track record.
Good dividend yield.
Proactive approach to risk management.
Sounds like a pretty good package.
But just like with MFA,
Gotta weigh those potential risks.
so we've examined both companies in detail
MFA.
and Annaly. What key takeaways should our listener keep in mind when comparing them?
Well, the crucial thing is understanding their different approaches.
Okay.
MFA,
Yeah.
targeting potentially higher returns,
With those non-agency MBS.
but taking on more risk.
Right.
And
Right.
Annaly aiming for stability
Inconsistent income.
through agency MBS and that leverage strategy
Okay.
and their payout ratios
Yeah.
and their financial health.
They offer different perspectives on dividend sustainability.
It's about aligning your investment goals
With the company whose strategy best suits your risk tolerance.
and income needs. So it's not just about chasing the highest yield.
Exactly.
It's about understanding the fundamentals and choosing the company that aligns best with your individual investment strategy.
Now, we've touched on some risks specific to each company,
Yeah.
but let's zoom out a bit.
Bigger picture thinking.
I like it. Hot, broader trends in the housing market,
Could impact both MFA and Annaly.
regardless of their individual strategies.
That's a great question.
So beyond interest rates,
Yeah.
what are some of the big forces at play?
Well, one of the most significant factors
Okay.
is demographics.
The makeup of the population.
Plays a huge role in housing demand.
Right. Things like
Millennials entering their prime home buying years.
or baby boomers downsizing
Exactly, those demographic shifts.
can have a ripple effect throughout the market.
For sure.
What kind of impact could that have on companies like MFA and Annaly?
Well, think about it this way.
Okay.
If millennials embrace home ownership
Mm-hmm.
with the same enthusiasm as previous generations
It could lead to increased demand,
and higher housing prices,
which would benefit both companies.
in theory, if they delay home ownership,
Or prefer alternative housing options.
it could create a very different scenario.
Interesting.
And similarly,
Yeah.
if baby boomers flood the market with their larger homes as they downsize,
Could lead to an oversupply,
they potentially depress prices
which would impact both MFA and Annaly.
negatively.
So demographics are definitely something to watch.
Absolutely.
A powerful force.
They are,
And then there's technology.
which is constantly evolving.
We're seeing innovations in construction techniques,
Smart home features.
even virtual reality tours.
It's amazing how fast things are changing.
So how could these advancements impact the housing market?
And in turn, companies like MFA and Annaly, well, technology can be a game changer.
For better or for worse?
Exactly.
Give me some examples.
Okay, so more efficient construction techniques
Yeah.
could lead to an increase in housing supply.
Which could put downward pressure on prices.
Right.
But on the other hand,
Tech-savvy buyers.
might be willing to pay a premium,
For homes with the latest gadgets and features,
driving prices up.
it's a double-edged sword.
And then there's the potential disruption of 3D printed homes.
Or the rise of co-living spaces.
It's hard to even imagine what the future holds.
The possibilities are endless.
The technology is definitely a wild card.
A big one.
And speaking of disruption,
Uh-oh. What else could shake things up?
we can't forget about policy changes.
Government regulation.
Tax incentives.
Zoning laws.
They all play a role in shaping the housing market.
A big role.
So how could those factors affect MFA and Annaly?
Well, policy changes
Yeah.
can create both opportunities.
And challenges.
Exactly.
Give me an example.
Okay, so affordability initiatives
Uh-huh.
aimed at first-time home buyers
Could boost demand.
and benefit both companies,
Right.
but policies designed to curb investor activity.
Could have the opposite effect.
less demand,
lower prices,
protection
and zoning laws that restrict new development,
could impact housing supply,
leading to price increases.
which could be good for MFA and Annaly.
Right.
But those same restrictions,
Could also limit their options for acquiring new properties.
creating a challenge.
So it's a complex interplay of forces.
It is.
Policy changes can be unpredictable.
For sure.
So as we can see,
Right.
the future of these high-yield dividend stocks,
MFA and Annaly,
it's deeply intertwined with those broader trends.
shaping the housing market.
And while they have different approaches
Managing risk,
and generating returns,
they're both susceptible to those larger forces,
it's a dynamic landscape
full of potential pitfalls,
and exciting possibilities.
which is what makes it so fascinating.
Absolutely. Okay, so we've covered a lot of ground in this deep dive.
Yeah, we've explored
The nuts and bolts of MFA Financial and Annaly Capital Management,
those dividend yields,
analyze their financials,
examined those potential risks and opportunities,
but most importantly, we
give
gift
you,
through
equipped you, our listener.
with the knowledge and insights you need to make informed investment decisions. That's what it's all about.
Empowering investors.
Any final words of wisdom for our listener before we wrap up?
Yeah, I think the key takeaway here is
Yeah.
don't just chase the yield.
Don't get blinded by those big percentages.
Exactly. Understand the company,
That's strategy.
its potential risks and rewards.
Do your due diligence.
Absolutely. And remember,
Yeah.
staying informed about those broader market trends.
The ones we discussed.
Those are crucial,
Knowledge is power.
especially in the world of investing.
Couldn't agree more.
So keep learning
Keep exploring.
and keep asking questions.
Excellent advice.
Thanks.
So to recap,
Yeah, let's hit those key takeaways one more time.
first and foremost,
Diversification is crucial,
don't put all your eggs in one basket.
no matter how tempting it might seem.
Spread those investments around.
Different companies,
Different industries.
different asset classes,
It helps to mitigate that risk,
and create a more resilient portfolio.
like a well-balanced meal.
Exactly. You need a variety of nutrients to thrive.
Just like you need a mix of investments to achieve your financial goals.
Love that analogy.
And another key point,
Look beyond the yield.
that shiny percentage,
It's just the tip of the iceberg.
dig deeper into those payout ratios,
Earning stability.
cash flow consistency.
Those tell the real story about whether those dividends are sustainable.
It's like buying a house.
How so?
You wouldn't just look at the curb appeal.
No.
You'd want to inspect the foundation,
The plumbing,
the electrical.
make sure everything is solid,
Same with investing. You got to look under the hood.
make sure the company is financially sound.
Absolutely.
And finally,
High yield stocks.
they should be part of a balanced portfolio.
Not the whole enchilada.
They can be a great source of income.
But they shouldn't be your only investment strategy. You need a mix of growth potential
Stability,
and those income generating assets.
all working together to help you reach your goals.
Think of it like building a strong team.
I like that.
You need players with different skills and strengths.
To achieve success.
So there you have it.
Our deep dive into high-yield dividend stocks.
Tailored specifically for you.
Our knowledge-hungry listener.
We've explored the mechanics,
The risks,
the rewards,
and hopefully,
giving you the insights you need to make informed decisions.
remember,
Yeah.
investing is a journey.
Not a destination.
So keep learning.
Keep exploring.
Keep asking those questions.
Never underestimate the power of knowledge.
It's the key to unlocking your financial potential.
Well said.
Thanks.
We hope you've enjoyed this deep dive.
And we'll see you next time.
For another fascinating exploration.
Until then.
Happy investing, everyone.